All right, well, good afternoon, everybody, and welcome to my webinar for today. I know there's a lot of people who are joining via Facebook Live, so if you're on Facebook, welcome. For those of you who are on Facebook, if you have questions, feel questions into the Zoom chats, and I will respond to those as quickly as I can. So let's go ahead and get started with the update for this week. So first of all, what are we going to cover? As always, we cover a rate update, kind of where market rates are at and the trends that I'm seeing. But I'm going to spend a lot of time talking about how to buy a home after a forbearance. FHA just came out with their guidance. They were the last of the loan programs to give guidance on how we treat people who had previously been in forbearance. And so that is an important thing that I want to share with you so that you can help your buyers and prospective buyers understand what their options are in purchasing a home after a forbearance. We'll go over big picture, all the programs as well on how to buy a home post forbearance. And then we're going to talk about a guideline enhancement and specifically around accessory dwelling units. But a big piece of that Fannie Mae came out with has to do with manufactured homes as an accessory dwelling unit. And really, really good news there. So I'll share a little bit about that. And then we'll talk about down payment assistance programs that are going down to as low as a 620 credit score. And I'll share some really good information about that as well. So let's go ahead and get started. All right, so rate updates. We are seeing a pretty solid trend of flat rates. Now, what you're seeing, as I've mentioned every other week, you're seeing the back end of the mortgage markets. So you're seeing what our cost is on funding loans, and the higher the chart goes up here, the lower interest rates are. This is essentially the value of a mortgage. And we're seeing in the short term some volatility, but guys, this is a normal amount of volatility. What we've seen before, and I'll kind of skip ahead one slide here, is this huge amount of volatility over here is what you're used to seeing, or at least what we had been seeing back in March. This is huge volatility. Our volatility has really calmed down and rates have continued to trend better over the last few months, significantly better than they were late last year. But what I want to share with you is putting that into context on kind of what the rates look like for the last year. And I know this is a jumbled mess of squiggly lines, but what you're really seeing here is you're really seeing a good breakdown of where interest rates have been. And just pay attention, for example, the light blue line is the 30-year jumbo loan. The dark blue line, the royal blue, is the 30-year conforming loan. FHA being purple, or I don't know what color. What's the difference between the FHA and the VA? Is that fuchsia versus purple? I don't know. I don't know my colors very well. Anyway, so purple and other purple. So we've got the two purples, USDA, and then a 15-year loan. And what you're noticing is you're noticing everything moves in a pretty consistent pattern, but they don't move exactly at the same time. And a perfect example here is you see the VA 30-year fixed rate in general is the lowest rate you're going to find on the chart. And the VA 30-year fix sometimes is a lot higher than the conventional 15, but there's times when it's literally touched. There's times when the 15 has touched. So here the 15 didn't drop, even though in late May, we had a huge quick drop in 30-year rates. We did not see the same drop in the 15-year. We didn't see the same drop in jumbo. A little bit of a drop in jumbo, but nowhere near as big. But what you're seeing, and by the way, this is March. This is the huge volatility that we saw in March. But what you're seeing big picture is rates continue to trend down. Even as they pop up a little bit, they keep trending down. A little bit of an up and then a down, a little bit of an up and then a down. But sometimes we've got a 30-year coming down, even though a 15-year is flat. That's just a dynamic of the market that is hard for buyers to understand, but it is the different duration of the loan has a different value to investors long term. And a 20-year loan is a perfect example of a loan that doesn't make sense today. A 20-year loan is actually a higher interest rate in a lot of cases than a 30 or a 15. Most people are taught, you probably thought, that anytime you do a shorter term loan, you get a better interest rate. But here's what's the dirty little secret about the 20-year loan. People do 20-year loans because they want to try and pay faster, but they can't afford to pay off in 15 years because 15 is the norm of a faster payoff term. So if you had the income to pay off in 15 years and you wanted to pay off faster, you'd do the 15-year loan. The fact that you're doing the 30, excuse me, the fact that you're doing the 20 means you don't have quite enough income to pay for the 15. In other words, you're stretching yourself to get to the 20. Those 20-year loans default at a faster rate than a 30 or a 15. More people are unable to pay 20-year loans than 30 or 15-year loans because statistically, very few people do 20-year loans, and those that do are stretching themselves to try and pay at the absolute max of what they can qualify for. Otherwise, it'd go at the 15. And so by nature, it's a higher risk loan. There's some weird anomalies in here where you will find that interest rates don't add up. What we're seeing is nowhere near as big of a difference between 15 and 30-year rates as we had seen in the past. And that's something that your buyers need to understand, because I am a huge fan of paying off your home as fast as you can, but I'm not a huge fan of locking yourself into that higher monthly payment unless you get a big benefit for paying that higher required payment. It's only a little bit higher interest rate and pay it off in 15 years. It gives you the insurance policy to fall back on the lower 30-year payment if your client or the buyer or the homeowner ends up running into a financial difficulty. Otherwise, they're going to end up having to refinance the property. And what if rates are significantly higher at that time? Refinancing would be a bad idea. So because there's a small difference between the 15 and the 30-year loan, I am not a fan of 15-year mortgages right now, as long as the homeowner can be disciplined enough to write a monthly check greater than what shows up on their mortgage statement. That's the key, because a lot of people don't have that discipline. And if you can't get yourself to write a check more than what shows on your mortgage statement, you're never going to pay it off faster, because you're simply going to default to what it says on the mortgage statement. That person needs the 15-year loan. But the person that has the discipline to pay extra, they don't need the 15-year loan. So this just kind of gives you an idea of where rates are going. Again, a lot of volatility in the short term from day to day, but the long term, you see interest rates continuing to go lower. So my rate advice hasn't changed. If you're refinancing, we are not locking rates up front. If rates end up a little bit higher, here's an example where rates went up. So if you were right here and like, my gosh, John, that was horrible advice. When I talked to you, rates were down here and now they're up here. Yeah, but they came back down. Like every one of these peaks, and I can't promise that's going to happen forever, but I feel really confident it's going to keep happening going forward. We're going to see peaks and valleys, but in the long run, we're going to see rates continue to go down. The problem is when you're purchasing a home, you don't have time on your side. So you need to lock as soon as you think it is realistic to get, when you get in the contract, unless you want to really risk that you hit one of these peaks and now you have to lock in, and that would be the worst case scenario. So I suggest lock as soon as you get a contract accepted. So this just compares the two charts side by side. You see the flow for the last year, that the value of mortgages have consistently been getting higher, and you see that the interest rates have consistently been getting lower. Now, what you haven't seen is this chart's gone up a lot, yet this chart has not gone down anywhere near as much in speed and amount of drop in interest rates. And that's why I keep telling people there's more room for rates to go down. Now, we got a lot of things that can change that. Obviously, the election is the biggest wild card coming up that is an unknown. We're gonna have to see what happens with the election, but I don't think it's gonna change the long-term trajectory of rates. We're definitely gonna see a lot of volatility in the meantime as we wait to figure out how the election shakes out. All right, moving past interest rates. Let's talk about FHA's recent guidelines they posted last week. I'm going to go through these real quick, but I'm going to give you a pretty thorough breakdown. In the past, FHA said, look, if you had a forbearance, we can, and by the way, this is all about what type of loan you're doing on the new transaction. So if you're doing FHA to purchase or refinance a home, we have to look at these guidelines. If your old loan was, I don't care, FHA, conventional, whatever, but your new loan is conventional, then these guidelines don't apply. The conventional guidelines apply. What we care about is what are the rules on the loan program that we are using for the new loan. We don't care about the rules for the loan program of the loan you're paying off. So FHA says, look, we're okay doing an FHA loan for someone who is granted a forbearance as long as either number one, they made all of their regular payments and the plan is terminated. That's a huge win, huge win. If somebody did not skip any regular payments, there's a lot of people who were put into forbearance that didn't know it or didn't realize they were put into forbearance, and they made all of their monthly payments. We now have the ability using FHA to qualify that person immediately with no waiting period, as long as the forbearance plan is terminated and we can prove that they missed no monthly payments. Now, FHA says, but if you're doing a cash out refinance and you completed your forbearance plan, so by the way, if you made all your payments, you're fine. We're done right there. You never missed a payment, done. You can do a purchase, you can do a refinance, you can do anything you want. Or on a cash out refinance, if you've completed the forbearance plan, in other words, you had payments that you skipped and you did not make all your payments on there, and now they have either, it doesn't matter whether you caught up the payments or whether you put them at the end of the loan, FHA says we don't care. All we care about is you skipped payments. And if you skipped payments and you're doing a cash out refinance, you got to wait a year. That's the bad news. The good news for a lot of you is you don't care because you don't have buyers who are doing cash out refinances on FHA loans. So that's very rarely going to be an issue for you. What you're worried about is, what about if I'm purchasing a home using FHA? They completed the forbearance plan. They have to have made 3 consecutive monthly payments. So FHA says, we don't care whether you caught up the payments. We don't care whether you put the payments at the end of the loan. If you've made 3 on-time payments after your new payment started up again, you qualify to purchase or to refinance without pulling any cash out. The last 2 have to do with what's called a streamlined refinance. I'm not going to go over those rules, but very simply, FHA gave us guidance that if somebody has a current FHA loan and they want to refinance to another FHA loan, they can utilize a streamlined refinance. This may be applicable for some of your past clients. Maybe somebody bought a home a year ago and they have an FHA rate at 4.5%. And you called them up to check in because you're making all your calls to your past clients, right? Right? You're calling all your past clients, right? Right. So you're calling your past clients, you're checking in with them, and they say, yeah, you know, I heard rates are down. You're like, yeah, they're down. Let me get you in contact with John King. He's absolutely amazing. That's the only right answer at that point. But you say, hey, let me get you in contact with John King. Oh, no, I already talked to another lender. They said I can't refinance because I was in forbearance. Well, you know what? We've got some options now, and that's where the streamlined refinance comes in. So we have ways that we can help people. There are still waiting periods. We've got to pay attention to that, but you need to stay in contact with your past clients and help them have the love it or list it conversation. You've heard me talk about this many times in the past. They either love their home and they're going to stay there, in which case they need to refinance to get a lower rate, or if they don't love it, now is the time to sell it and to buy something else, capture low interest rates on the next house that you're buying, and sell your house in a super, super hot market. All right, so that's the big picture on FHA guidance to purchase or refinance after a forbearance. I now want to kind of twist this around and give you a very simple thought process on how every loan program looks at it. If somebody was in forbearance and never missed any payments, they can do any kind of loan they want. FHA, VA, and conventional are now aligned. It's rare that I can say they're aligned. They are now aligned that you can do a mortgage immediately as long as you never skipped any payments at all. The next section is where they diverge. Conventional says, if you skipped your payments, but you repaid them, you caught them up, you can qualify immediately. So, and VA, by the way, is the same thing. You can buy right away as long as you caught up the payments that you skipped. The alternative, instead of catching them up, is to put them at the end of the loan, a modification. So FHA says, we don't really care whether you caught up your payments or put them at the end of the loan. You got to wait 3 months after the end of the forbearance. So conventional and VA, if you skipped payments, but you repaid the payments you skipped, you're fine for conventional and VA immediately. FHA says you have to wait 3 months. And then if you skipped payments and you put them at the end of the loan, VA still says you can buy right away, but now conventional agrees with FHA and says, nah, you got to wait 3 months of making 3 on-time payments. Guys, I'm super happy to have this clear guidance to give to our buyers. It was a nightmare with FHA because we had people who had previously done a forbearance. They're trying to sell that house and buy something else. And the best I could tell you is FHA doesn't have a rule. And we think that they're basically making us apply a 12-month waiting period currently. So if you have any buyers who were thinking about buying a home that had a forbearance and they were needing to do FHA as a new loan, this is the perfect opportunity to reach back out to them and say, hey, my amazing lender, John King, has an opportunity to help you out with an FHA loan, and it's okay that you had a forbearance. As long as you've made 3 on-time payments after the forbearance, you can qualify for FHA, no problem at all. Again, guys, huge, huge news, huge opportunity to help people take advantage of the great interest rates that are out there right now and help them to purchase a home. All right, if you have any questions about this, if you're on Facebook Live, then post your questions on there. If you're on Zoom, post your questions on Zoom. Otherwise, I'm going to move on. So Fannie Mae issued a clarification last week on accessory dwelling units. And this is the clarification Fannie Mae said. They said, obviously, an accessory dwelling unit is an additional living area that is independent of the primary property that has basic bathroom, cooking, and sleeping facilities. And they expanded their current definition of ADUs, accessory dwelling units, to improve the proper classification of accessory dwelling units. And here's the big one. They expanded property eligibility by allowing multi-wide manufactured homes titled as real properties to be eligible as an ADU. Randy Elliott joined us, and Randy has had this exact question come up maybe a month ago, and he could not find a lender who could do it. And it was a situation that happens way too often in the Central Valley, that you have a beautiful property that is out in the country, and the homeowner decides, you know what, I'm going to build a second house on my land, but what's the least expensive way I can do that? I know, I'll have a manufactured home brought in, I'll have it attached permanently to a foundation, I'll have it put on the land, and that will increase the value of my home. And until now, it's done the opposite. And it may not have decreased the value, but it's made it almost impossible to get financing, because we would treat that property as a 2-unit property, because we could not call it an accessory dwelling unit per Fannie Mae's guidelines. And Fannie Mae wouldn't allow 2-unit manufactured homes. And if one of the properties is manufactured, then we fall to the manufactured guidelines, and it says single family only. It was a catch-22. And there were very, very few lenders out there who could do it. Randy and I were just talking about a month ago about the fact that one of the lenders that had done them for him previously said, nope, we can't do it anymore post-COVID. We just have lost all of our options to make that happen. So I'm super, super excited to say that's now an option that allows us to do a loan on a stick-built home that also has a manufactured home listed on it. What matter? I had to go through 9 lenders before finding one. That's correct, Randy. But you didn't give up. So Michelle's happy. She learns from you all how to make it happen. But now, Randy, you only have to go through one lender. That's right. That lender's me. Don't you forget it. Tell everybody you know. All right. So bottom line, guys, this is absolutely huge news, because as Randy found, like, it's tough. And when you get to the 9th lender, it's typically not the best lender. Randy, I don't know what you're dealing with them, but obviously your first 8 choices were probably the choices that you would have preferred to work with. So having to work with the 9th lender isn't necessarily going to be the person that's going to give you the best service. So for anybody that has this situation, this is now a Fannie Mae guideline. I can now do these properties. And they did give a little more flexibility too, because there's been issues with property comps. And on any type of property, we have to make sure that that feature is marketable. Give you an example. An example is a property that has a garage that's been converted to a living space. Okay, we're okay with that, because as long as it was in a workmanlike manner, we're fine with the fact the garage has been converted to a living space. What we're worried about is there a market for homes that don't have a garage? And that's what we have to figure out, is the appraiser has to go out there and find a home that has sold that has no garage to prove that people are willing to buy homes that don't have garages. The same holds true for accessory dwelling units. And it's been an issue where we have to be able to prove that, as they put, demonstrate market acceptability of the accessory dwelling unit. They're now saying that they can use an older sale to demonstrate market accessibility. And you can use an active listing or pending sale as a supplement to show marketability. So that's huge win, because when we have some of these unique property attributes, a dome home being another example, we run into problems of, hey, sure, we can appraise it, but if the appraiser can't find another dome home that is sold recently and within a reasonable proximity of the home, then we don't know that dome homes are marketable in this marketplace. And that creates a major problem from a lending perspective. All right, the last thing I want to cover, and then I'll get you out of here a few minutes early, is down payment assistance options down to a 620. When the pandemic hit, we lost a lot of low FICO score options. Our down payment assistance programs quickly went from a 600 minimum credit score all the way up to a 660 minimum credit score, and then they went away. And then when they came back, maybe they went away first and then they came back at a 660. Anyway, don't quote me on the timeline. The fact is that they were gone and they went to a higher minimum credit score. So we ended up dropping then to a 640 a little while back. And then just recently, we've been able to drop down to a 620. I am hopeful at some point in the near future, we'll be able to drop down to a 600 FICO score for down payment assistance. But I want to point out kind of how this program works. It's the GSFA open door program, and it gives the money in two ways. You get a second mortgage and you get a gift. The second mortgage has no interest charged ever. You have to pay it back, and it's 2% of the first mortgage loan amount. So almost 2% of the purchase price. And that covers a portion of their 3.5% required down payment. And then you get a gift. The gift varies based on the interest rate you get. If you don't want any gift at all, then you can get a rate as low as 2.625. So that's giving you 2% towards your down payment, which means you only have to come up with 1.5% down. But remember, the fees on down payment assistance loans are significantly higher. There isn't any revenue for the lenders on the back end of these loans. And so instead of charging you 1 point, you're paying 2 points as an origination fee on these loans. So it's definitely more expensive, but that money can be paid for through a seller credit. If you have a property you can negotiate a seller credit on, or it can come from a gift from family. A lot of different ways we can make this work. But the cool thing is you can get up to 5.5% of the purchase price as assistance. Oops. You get up to 5.5% of the purchase price as assistance. 3.5% of that is a gift you never have to repay. But this gift horse, you may want to look in the mouth, because this gift is pretty expensive. You're paying a 4.75% interest rate. These rates have been pretty volatile, especially there's a huge Mason-Dixon line here, guys. We see 3.25 gives you 2% gift and 2% second, 4% total assistance. But to get just an extra 0.5% in assistance, you got to pay 1.25% higher in rates. That's a dramatic jump in interest. And so our challenge right now is for clients that need, let's call it, 3.5 or 4% assistance. Every once in a while over the last few weeks, this level of assistance has crossed this Mason-Dixon line and become a much, much more expensive loan option. Then the client freaks out. Oh my God, John, my rate went from 3.25 to 4.5. Well, no, not really. We just have to decrease your amount of assistance. Because if maybe a month ago you could have gotten 4.5% assistance for 3.25 rate, but if you just go to 4% assistance, I can still give you a super good interest rate. It's just it has to do with the amount of value that exists as rates go higher, and it's diminishing returns right now. It's the simplest way I can say it. We're not seeing value in the marketplace for a 3.75 interest rate. It's worth just the same as a 3.25 or a 4%. There's a little bit more value when they get to the 4.5% interest rate, and that's what allows them to give you a little bit more assistance, but you got to jump way up in interest rate. So the sweet spot is right around here. Ideally, I'm giving you the 3.5% for down payment so that no seasoned funds of the borrower's money has to be used for down payment. This is beautiful when you have maybe you got a buyer and seller that have an existing relationship that they're willing to help each other out. Maybe you have a tough property that hasn't been easily sold and the seller is more than willing to give closing cost credits. This is a great way to put that property together and market that property to first-time home buyers. I know there aren't very many tough properties out there that aren't flying off the shelves right now, but it is something to think about if you run into to it, this is a good way to market that to first-time home buyers, give a decent seller credit instead of lowering the price, and you're going to find some grateful first-time home buyers that are having a hard time getting into a home when they need closing cost credits. All right, gang. So down to a 620 FICO score for down payment assistance. Huge opportunity to help people out. Aside from that, guys, we got 5 minutes left. I'm done. So if you have any questions, feel free to post them into Zoom chat or into Facebook chat. Otherwise, I'll give you back a few minutes of your day. I appreciate your time, and I look forward to helping you out as your buyers are looking for assistance on their next home loan. I'm your guy. We'll talk to y'all soon. Bye-bye.